As I said, we are going through the different topics before we come to the review, and this means we are trying to continue things we have been talking about before, and we are trying to make sense, increasingly sense about the different, or from the different topics we have been talking about. Economics, on the one hand, we have to understand the details, the nitty-gritty. We have to go through the definitions and the different calculations and all this, but at the same time, we have to understand the entire economic framework. How not the single thing works, but how the complex system of the economy works. One of the very important points here is that we are talking sometimes about something that seems to be the same, but that is actually different. Money and capital. The initial idea, or what comes to mind immediately, is money is capital. Capital is money. As we said, this is not the case. You have different forms, you have different dimensions of what actually money is, a means of exchange, storing value, not having value. But capital is something we invest and we want to have a return from this. This is important to understand because there are different ways actually of the value things represent. Money, of course, represents a certain value. We can go into the shop with the banknote we have, with the coins we have, and buy something. In this way, it represents a certain value. It doesn't have value. Capital is a different story. And there are these two very important points with capital. We said there are fundamentally two different forms of capital. That is constant capital and variable capital. But we have, in this context, the one idea of depreciation of capital, meaning that the value is transformed, is transferred into the product. We can especially understand it when it comes to raw material. When we build a table, for building the table we need timber. And this timber is completely used after the process of production. It's in the table. Some may be wasted, meaning it's as well depreciated, but there is nothing left after it. As well, constant capital, the depreciation of a machine, of tools. After some time, the machine is literally devalued. You have this in accounting. You put something into the goods, into the books. It is there as a value. You have a computer. The value of it is 2,000 units. The second year, it's not 2,000 units anymore. The computer is still there, but you can use it as a metaphor. 500 units of the price of the computer is transferred into the goods that had been produced. So you have a depreciation of 500. It is transferred into the goods. It's not there anymore. Of course, the computer is still there. Of course, the computer still functions. But in terms of economics, in terms of accounting, it's depreciated. The value of it is lower than it had been. There are different rules, but at some stage, the computer doesn't show up in the books anymore. You may still have it. You may still even work with it. But in terms of the value, in terms of the books, it doesn't exist anymore. It's completely depreciated. There is one capital, labor as investment, V, that is actually appreciating. It creates value. Of course, it is used as well in terms of depreciation. You are getting weaker. Possibly in the morning you are fresh and full of energy and you want to work. And at lunchtime you get a little bit tired. And after lunch you are especially tired. And in the evening you are really tired and you can't work anymore. Depending on the job, how much time can you spend working, how much energy is needed, what kind of energy is needed. There are some jobs, the energy you need is so high, you can do it for 5 or 10 minutes, and then you need a break. The concentration it requires, air security. They stop with 40, 50 to work. They get in retirement. Because it is such a strain on everything that they can't work longer in this job. Interpretation. These are jobs, actually, literally, they take 5 to 10 minutes and they have to make a break. If it's official translation, it's a very short time. Of course, they don't stop the working day. They may do something else, or they come back after their break. Appreciation, nevertheless, because what they do is they create value, meaning after investing this work, you have more value by transforming the depreciation, by transforming the value of other goods into the new product. This is important to understand the different kinds of capital. And, of course, you have this difference between, and this is even more important, between capital and money. Money is not capital. Now, sometimes it's a little bit difficult to say what exactly is actually capital. Where is the bond? Of course, you have these cases where it's obviously difficult. If you have a car, you use it for private transport and you use it for your business. Is it capital? Is it a consumable? This is one obvious difficulty. I use my computer for work, and I use it for anything else. Private, capital good. The other thing, the other difficulty is more definition of non-material goods. So you have the small assets of the household, you have the car as well, the house, which is of course an asset, it's capital, you can at the end trade with it. But then you have as well non-material items, brand names. And then you have huge disputes about these brand names. It's occasionally a funny thing. It just comes to my mind one, because this is one of the things I remember because it's so ridiculous. Lacoste. Lacoste, you probably know, heard, possibly know this brand name. Lacoste, they produce T-shirts and shirts and things like this. The symbol is a crocodile. A little crocodile you find on the T-shirt, and this makes it a Lacoste T-shirt. Now, I don't know exactly what happens to the crocodile. It has to look into a certain direction, and the tail goes into the certain direction. Now, people said, okay, this brand name is protected. Registered trademark, Lacoste, it stands for a certain quality. It sells very expensive. So what do I do to sell under the name, not really under the name, but with the impression of this is Lacoste? I cannot copy it. This is infringement, but I can make a copy of the crocodile, which now looks into the different direction. Instead of looking right, it looks to the left. And I have the tail, instead of going up, I may have it going straight. Something like this. It's a small change. Everybody who looks at me sees the crocodile. Ah, right, Lacoste. Great. Good brand. It's not. This was going so far that you could actually buy these fake crocodiles and put it on any T-shirt to give this impression of it is a brand T-shirt. Non-material items, but the name of Lacoste, the name of Microsoft, the names, these brands are protected. They are capital. And you find it in many instances as franchising. I didn't know it for a long time, and I always thought this so-called restaurant with a large M in gold on red background, they have so many different branches. They don't. There is no real, well, there is a few real McDonald's, but this is franchised. So you basically kind of buy the brand name or part of it, franchising, and you open your own McDonald's. It is not owned by McDonald's, but you pay for using the brand name, so it's capital. As I said, mixed goods, cars used for business, private purposes. This is one dimension of the problem. Another problem, or another dimension of the problem we have to discuss, is, of course, that capital on the financial market, when we talk about its money form, is linked to the different monetary aggregates. This is important to understand as well. Where is actually the capital located? Is it easily available, accessible, or is it something that is invested in long-term strategies? This is important, hugely important as well for the interest rate. So if I say, I want to guarantee myself having access to money immediately, I can do it. The current account, for instance, I can go to the bank. I can go now 24 hours to the bank in terms of internet banking or the ATM. It's immediately there. but I don't get really interest for it. The interest rate is very, very low. If I say to the bank, here's the money, you can have it for 20 years. That's a different story. And I get actually a reasonably high interest payment for it. So in this way, it matters where actually do I put my money in terms of the money aggregate. Short-term, long-term, or medium-term investment. Another reason for the importance of this is, I said before, I referred before to the depreciation and appreciation of capital. Some capital is creating value, it's producing something. The machine as such doesn't do so, but human labor does. And we talked about it, the profit rate, if I invest into machines, the profit rate decreases. The profit as such increases because I sell more products in terms of real products, but the profit rate, meaning the money I get per item, the money I get from my investment related to what I invest, is decreasing. So the economy has a problem here, meaning the overall economic system. Of course, investment means I want to have return. I want to get money out of it, and I want to get more money than I invest. The one thing is, I'm always happy if I invest 100 and get 200 back. That's a good thing. If I invest 100 and get 300 back, it's even better. But at the same time, the relation matters as well. It's not only how much do I get back in absolute terms, but as well how much do I get back in relative terms. So you start at the other end. To get 200 back, 200 additional value, how much do I have to invest? And this is depending on how much do I have to invest, or how much do I invest into C or into V. Into constant capital, the higher productive machines, higher productivity than my manual labor, but the relation, what I get back, is getting smaller. So this is something where I have to be a little bit careful, because at some stage I have this rationalized system so much perfectionized that I don't get anything back. The machine does the work and everything is fine. I heard actually from somebody, this is the brutal story, the brutal part of it. He had been employed to elaborate the computer system that was in many years back, 25 years back or something like this. He had been employed by a relatively small company to establish the computer system. What kind of software do we need? How do we run it? How do we automate the system? This is the problem if you are too good. He said at some stage, it's working now, it's perfect. And the boss asked, tell me more about it. You just switch on this machine and it works. And he said, thank you very much. Now I can do it. you can go home and you are unemployed. So this is the extreme. The system works on its own. You don't have to pay anybody. And it works, of course, and doesn't produce any additional value anymore. Now, what is the way forward? How do we deal with it? On the one hand, we need employment. On the one hand, we can, what I said here, we can commodify everything. If you go, I'm one of the culprits there. If you go earlier, a couple of years ago, you went to the fruit shop, you bought your apples, you bought your bananas, you bought your kiwi, whatever, and then you had been going home with it and preparing it, peeling it, cutting it, whatsoever. Today you go to the shop, you get your little plastic thing there, it's already clean, it's peeled, it's basically ready to eat. I'm terribly lazy in this respect. I go there, you go to the shop and you have your ready-made meal. This is what households did before. They did it, we talked about GDP, they didn't do it as business. They bought the raw material and they did the work. Now it is a company, a small company, a large company, that actually pre-produces these things. There are many things you can include into the markets. Commodification. And it is a commodification in terms of a real market. Meaning, I looked recently a little bit into it in a different context. You know this R&B, I think. You don't book a hotel, but you have some things like R&B also. And I checked the business scene a little bit more. You get strange things of dog walking. If you have a dog, but you don't have the time, you are too weak, elderly people or whatsoever, you don't want to walk with your dog, so you get dog walkers on the internet, like R&B, like Uber or something like this. I'm looking for somebody Tuesdays from 8 to 9 walking my dog. There is a whole business, and this is not like asking a neighbor, asking a child living in the neighborhood, now can't you do this for me? This week I'm extremely busy. Can you look after the dog? Just go occasionally. You get a $5 for it. But this is business. So it's a new stage, commodification of everything. And then the other thing is the financialization, meaning the finance market as an independent sector. Money doesn't work as much or in the same way as money doesn't have value. There is always this saying, at least in English or in European language, let your money work. The idea is bring it to the bank, you get interest rate, you invest into something, you invest into bonds, into hedge funds or whatsoever, insurances, and the money works for you. The money doesn't work for you. I can promise you. You may get, if you invest enough, you may get rich, but the money does not work. It is the bank, it is the financial system that works with your money, but the money doesn't work. You cannot eat money, you cannot sleep on money, and you cannot ask your money to work for you. Nevertheless, we have an increasing sector of financial markets, of financial speculation, of financial investment, where you get money out of money. Of course, it's hugely problematic because you get money out of nothing. Try this and imagine something. There is something you want. Really imagine it. I really want this. And then take it. Nothing. Your hands will be empty. It's not there. Imagination doesn't allow you to make real value, make real use out of it. We talked about different forms of capital, and this was exactly what fictional capital is. It's a fiction. Somebody tells you it makes money, it works for you. It is a value. It is not. But nevertheless, it is increasingly important. Now, how does it work? On the one hand, you have, of course, this link, this kind of close link, or you have had this close link between money, capital, you invest it into something, and what you do is actually you buy shares into a real company. Stock market. It's the typical example. You go to the stock market, you buy your part of the company, and the company is real. And this is how it should be, meaning you buy 100,000, and 100,000 is there in terms of a real company. And somebody else buys 100,000, part of this company, which means 200,000 is there. And so on and so forth. Fictional capital means you buy 1 billion, and there is a company actually for 1 million. And the rest is fiction. The rest is speculation. The rest is just being built up by strange rules of insurances, of mutual insurances. This is a huge danger, and it is something where we have to look as well. I didn't do it in details, in all the details, but where we have to look as well at the source of income. From where do people get actually income? Now here it is divided into the majority, the bottom 80%, and the top, even here, top 0.1%. You still can say 80% get most of the income. If you relate it to the percentage of the people, you can say, or you can see immediately, there is a small amount actually paid in terms of wages, in terms of salaries, and the majority, in relative terms, goes to dividends and capital gains. This is the money that doesn't work, but it is there and creates in which way ever money. What you see as well, importantly, is this development. It's 1996 and 2006. The development that actually the amount, the gains from finance is increasing. You have an increasing number, or you have an increasing return on financial investment. So here is another long-term perspective where you see the development, the shift even in a clearer, more pronounced way, that the income distribution And we saw before from where the money comes, the income distribution is actually hugely changing in terms of in favor of a small number of people. National differences. It seems to be not a huge difference. If you look at 47.09 to 36%, or actually the higher is 69.9. Okay, this is an extreme, South Africa. But if you look at China, if you look at Denmark, this is more or less close by. It's 10%. It's of course a relevant number, but at the same time, in the overall perspective, you have huge differences. You have huge differences there as well, in terms of the income distribution. There is this concentration of wealth, and I'm talking now about wealth, income, which may be capital, which may be simply money, when it comes to the distribution and equality questions. Here again, another couple of figures related now to taxes, because of course this is relevant as well. If you have the money, this is the one thing, but what you do with the money in terms of redistribution. First you have the money and then it is redistributed. It's going by taxes, you contribute to this larger, whatever, community, national economy or whatsoever. If you link this to what I mentioned before, the huge inequality, you see that this inequality is not really reflected in the taxes people pay. Consumption taxes is a huge amount. Social insurance taxes, if you take them together, is a huge amount. Property tax, you have to be careful there because it is property tax on small property and large property. So if you have accommodation, you pay taxes for this as well because that is property. So you have to go through the different figures there and see that the tax is not used usually for real redistribution of income. Here another graph showing the sources of income, more or less long-term perspective in comparison, 1970 to 2005. It's the Americans, and this means the Northern Americans, where you see that the salaries and wages, the part of salaries and wages actually decreased. This is this nice saying, you don't really get rich by honest work. If you work, you have wages and salaries, but this doesn't really make you rich. And decreasing. What you get out of this is decreasing. At the same time, there is this increase from other income, especially interest dividends, although they slightly have been reduced. But business, net income, less loss is increasing. Net capital gain, and this is the important part, increased tremendously from 1% to 9%. So this is very important when it comes to thinking about different sources of income. The quantity theory of money is this strange thing used to explain the price level and the inflation rate, linked to the availability of money, but linked as well to the idea of the liquidity preference. We all like to have money in our pocket. The subsequent assumption is that the availability of money, of course, increases or decreases, is linked to inflation. Increase of inflation, if we have more money, and the increase of demand for goods and services linked to what we want to have. We want to have the goods in order to have control. This depends in itself on what we call velocity of money, the speed with which money changes hands. As I said, money doesn't have value. Money can store at least the representation of value, but at the same time, if the velocity is high, it has an effect as well. Which amount of money is actually available. So coming back to M1 and M2, M3, if the velocity is high, if the speed with which money changes hands is high, it means, of course, not literally, but in relative terms, there is more money available. Because you don't put it into your drawer, you don't have it under your pillowcase, but it is really available on the market. Which means that, coming back to the banks, there is the question, the political question always of increasing the available money. What does it mean? On the one hand, inflationary increases of price level. If there is more money available, we have an increase of price level, not for individual products and services, but on the general level. At the same time, we try to compensate for it in terms of the output. We produce more. And it goes hand in hand with a decrease of velocity, because we have to try to kind of manage with whatever we have in terms of money, in terms of value of money, or the representation of value of money, and what we can do with it. What happens? And there we come to the effect if the money supply defined by the central bank is increased. This is the first step that happens. And you have to go through the different steps. The first step that happens is you find an increase in money supply, meaning the central bank says there is now more money available in M1. The perceived value is decreasing. You have more money, and it gives you the impression the value of money is actually lowering. Which means at the same time, you have again an increase in terms of money supply to make good for it. So you arrive here, or you balance here, the two sides, the perceived value of money, and it's the perceived, not the real value of money, and the quantity of money that is available. So you have these different shifts there, And it is used and useful. It's an instrument for linking the different sectors, coordinating the sectors. And this is what we will do then for the second part.